Best Buy didn't have the best holiday quarter. The consumer electronics retailer reported a sales drop for November and December, and January wasn't enough to push sales above last year's levels. In fact, fourth quarter sales fell more than 4%, though in line with analysts' expectations. Mobile phones and computing products make up more than 40% of Best Buy's revenue, and sales in those categories were weak. What's worse, the retailer thinks the softness will continue. However, it did raise its quarterly dividend and issue a special dividend along with a $1 billion stock buyback. Best Buy has been undergoing a transformation since 2012, cutting costs, exiting its China division, investing for the long term, and cutting prices to better compete. The problem is, now that the bulk of those actions have been taken, growth has to come from sales, and that's getting harder to do. The retailer is heavily dependent on the product cycle for consumer electronics, from smartphones to TVs. But the pipeline of new, innovative, must-have consumer electronics has been pretty dry. Consumers aren't replacing smartphones as often. Tablet sales have plunged, and TVs just keep getting cheaper. But there is value in being the last big consumer electronics retailer. It's just questionable what that value is.
Best Buy is going to stick around. But because of the nature of the category being very big ticket and very product cycle dependent, demand becomes very volatile. So the way we look at it is that there's always a trade in Best Buy. A long-term investment scenario is something that is much more questionable.
Best Buy CEO Hubert Joly also said the company will use cash for strategic acquisitions to drive growth. And while Wall Street may be skeptical of any upside surprise in the near future, the general consensus is management is at least making the best moves to right the ship. For Nightly Business Report, I'm Courtney Reagan.